he is able to move into a product which is called the Home Ready product, and it allows him to go in if he wanted to. He could put 3% down. His mortgage insurance is going to be much cheaper than what it would be for you and I if we were buying that home. And in addition to that, they really are just gearing it in terms of putting the borrower in the best situation and allowing them to get in the house with great interest rates. So again, they're getting better interest rates than what you and I would get because they are in that bracket in terms of income.
Hey there, and welcome back to episode 2, or not episode 2, but 2 with Jerry.
Part 2.
Part 2, there you go. Thank you so much. Part 2 with Jerry. In this episode, we are going to get into very specifics on loan types. So if you are looking to buy and you have no idea what type of loans out there, Jerry is going to give us some good details on what that looks like.
So watch to the very end.
Watch to the very end. And of course, you guys know who I am. I'm Maisha Fair.
I'm Jeremy Orangel.
I'm Elyus Black.
And I am Jerry Stoltz.
Jerry Stoltz. And Jerry, thanks again for keeping us or having us, for 2 episodes here. So we want to get into some specifics about loan types. Obviously, we know some of the basics, conventional, FHA, VA. What else is out there?
Well, there's USDA for the outside area.
Oh, that's true. Yes.
So we have USDA, which obviously if you're not on the outskirts of town, you're not going to be looking at USDA anyway. You have VA loans, you have your traditional FHA product, you have conventional loans. There are, what we call non-QM products that are out there. It kind of goes into what we talked about in episode 1, where we talked about borrowers that maybe have some untraditional income. But I think in terms of first-time buyers, I think right now is a opportune time for them to be buying. I know people are worried as far as what interest rates are at, but I think they have a skewed view in terms of where rates were over the last few years. And I think that it's just a huge opportunity to be able to get into a house, being able to potentially get, concessions from the sellers and take advantage of getting a property that they're going to live in for years. And not to cut you off, but I know that when I watched one of the episodes, Elyus mentioned it, where, this is a house that you're going to live in for years, right? And you're getting a rate now, but in the future, we really anticipate rates are going to go down. And when they do come down, then you can take advantage of where the market is at that time. So.
And that, my folks, is called marry the house, date the rate. Which means if you have a high interest rate, because that's what you could get in at the time, you take it for the time, and then when rates drop, you refinance out of that high rate, get a lower rate, lower payment, more comfortable, and you still got the home that you love.
Yes.
And we can't stress enough that you have an opportunity to buy a house right now. As soon as those interest rates go down, there's going to be a flood of new buyers coming to market, and it's going to make it super, super difficult for you to buy a house when you could have bought one now and been in a better place to refinance at that time when interest rates do go down.
Yes.
Yes.
Yeah, and I think, the average consumer, and things have changed maybe over the last few years, but in my line of work, I've been doing this for 29 years, and I've seen a lot, and I've learned a lot. But the average homeowner will not stay in their loan for 30 years.
Right.
If you live in rural America and you live in a small little town, maybe you're going to live in that house for that time because you don't have the opportunity to move up into a new home because there's no other homes, right?
Right.
But when you live in a place like this and you're in Gilbert, and maybe you're a family that is a starter family, and next thing you know, you live in the house for 2 or 3 years, you have a couple of children or whatever the case may be, and next thing you know, that house is not big enough for you. And now you're looking to upgrade. So you can't get enamored over, oh my gosh, I'm paying this mortgage for 30 years or this is the rate, because you're only going to be in this house for a short time period. And as you mentioned one of the episodes too, real estate is an investment. And
so you mentioned a little bit about rates. We talked a little bit about some unique loan options like USDA and things of that nature.
Yes.
Those are more for the outskirts and things of that nature, different parts of town. But difference is most folks, and you mentioned first-time buyers, so most first-time buyers, for the most part, are getting into a conventional loan or an FHA loan.
Correct.
Can you tell our viewers what the differences are between an FHA and conventional, and how much does it take to get into one of those loans? How much is it going to cost to get into a house? Right. Is it going to cost $50,000? Like, what do I got to save, cash out my whole 401k? Like, what does that look like?
No. Well, again,
20% down.
No.
Yeah.
Well, that again, we were talking about misconceptions, and I think a lot of buyers they're sitting on the sidelines and they're like, well, I don't have 20% to put down, because that's just what they think, and that's not the case. I mean, as an FHA product, you assume that you're going to put 3.5% down. So you're buying, and again, just for easy numbers, $100,000 house, you're going to put $3,500 as a down payment. We also are seeing a huge flood from Fannie Mae and Freddie Mac, who are the biggest buyers of mortgages in the country, where they are really gearing towards first-time home buyers. And so you are seeing situations where you can get in with 3% down, and frankly, you don't even have to be a first-time home buyer. You could have already bought a home previously, and as we were talking in the intermission, if you make a certain amount of income, they are really gearing their products towards parties that make less income, because they're trying to get them into properties. And so Maisha and I were talking earlier today, we have a potential client that's looking at something. He's previously owned a home. He makes good money, but the income that he makes is less than what the average median income is for Maricopa County. And he is able to move into a product which is called the Home Ready product, and it allows him to go in, if he wanted to, he could put 3% down. His mortgage insurance is going to be much cheaper than what it would be for you and I if we were buying that home. And in addition to that, they really are just gearing it in terms of putting the borrower in the best situation and allowing them to get in the house with great interest rates. So again, they're getting better interest rates than what you and I would get, because they are in that bracket in terms of income.
Wow.
So what happens, Jerry? So say I'm new to the market, or even I owned a house before, but I don't have a ton of money to put down on a new home.
Right.
What does that look like? Because like Jerry said, do we have to put 20%? Like, what are we looking at?
No, I mean, there's so many products, and I think, again, that's why, you guys have reiterated where clients need to talk to us. I mean, they need to talk to you. They don't, they look at things online, they think, oh my gosh, I can't do this, or maybe they talk to a friend. But the thing is it's just about just trying to talk to us and communicate and find out what they do have, because some buyers will have money, like you said, in 401k, and they don't even realize that they can touch their 401k. Other buyers may have the ability to get a gift from their parents, or maybe a brother or sister that can help them. And then you do have products that are out there that are called DPA programs, so they're down payment assistance programs, and they will allow you to get into to the house with, potentially no money down. Some cases maybe 1% down. Wow. But there's just a lot of options out there for guys.
On those DPA programs, is it specifically FHA type loans, or are they conventional loans?
They typically roll in with FHA products.
Okay.
So you'll hold the first mortgage on FHA, and then as far as the DPA is concerned, so again, let's just say that they were looking at 3.5% down. So the financing on the first mortgage would be at 96.5%. So that's the financing that they're doing. And then that 3.5% would be on the gift side. And it's in essence, it's given to, well, again, we have different products that are out there, but you have some where the investor is actually gifting you the money. And as we discussed, the buyer could sign their loan documents, they could close on the loan, and then the gift is forgiven right at that point.
Wow.
They don't have to pay it back.
That's awesome.
And then you have other products that do require that it's not necessarily that it's paid back, but you have a certain time period before you can come back in and refinance it or sell your home.
Okay.
And let's say if you did sell it before the time period, then maybe you do have to pay back a portion of it. But again, it just boils down to there is just so many products that are out there. And yeah.
So we've talked a little bit about loan types, FHA, conventional, different amounts of down payments that you may have to come up with to get into a home based on the loan type.
Right.
What are sorry, I lost my train of thought. Appraisals, sorry.
Appraisals.
With regards to appraisals, what is an appraisal, and why, if I'm a first-time buyer and I'm financing my new home, why do I have to get an appraisal?
Well, appraisals...
do I have to get one?
And who's paying for it?
You don't always have to get an appraisal. If you do have some cases where, so what happens when we go back to the qualifying process we talked about earlier, when we run what we call findings, We run the findings through an automated engine. The engine will come back and it will let us know if an appraisal is needed. So some cases you'll get what's called an appraisal waiver.
Okay.
So in those situations, you don't have to get an appraisal. You would go to the buyer and you would say, hey, it's not required. It's going to save you money. But do you potentially want to get one? Some buyers would want to get one just because they want to know. Other buyers will be like, well, hey, if it saves me $550 or $600, then why am I going to waste money on getting an appraisal?
So the need to whether or not, excuse me, Jeremy, I'm sorry.
Okay.
So the need as to whether or not the buyer is required to get an appraisal is a predetermined factor on the lending side.
Correct. And that pertains to, let's say, conventional loans. If you're doing an FHA loan, you're always going to have to get an appraisal.
Okay.
If you're doing a VA loan on a purchase, you would always get an appraisal. A USDA loan, you would always get an appraisal. It really, on the Fannie Mae and the Freddie Mac, which are the conventional products, those are the ones that you potentially, and in most cases, the only reason they're going to get a waiver is if they were putting probably a decent amount of money down. So maybe you had somebody that was putting, I don't know, 20% down, but they had a very large amount of assets. So the system's reading that that particular borrower is very strong, and they feel like the need to have an appraisal is not there.
Less of a risk then for the lending institution, if you will.
Yes.
And who's paying for it? Is it always the buyer, or is there a way for it to be absorbed from the seller or something like that?
It is, yes. It's not always the buyer. Typically it is the buyer, but again, as you guys have seen over the last, the last year or so, you're getting a lot of concessions from sellers. So the seller could pay for it. With our office, especially if you had a borrower that just was in a tough spot, maybe they just couldn't pay for the appraisal right then, we have a good relationship with the appraisal vendors that we use, and we can look to invoice it. And then what would happen is they would go out, they would appraise it, and then it would just be paid at closing.
Oh, okay.
And so then it could be paid through the funds that they're getting from the seller. It could be paid by the buyer at that time. Or frankly, we have the ability with the way that we price loans where maybe if the borrower wanted to take on maybe a slightly higher interest rate than what they really qualified for, we then can build it where there's what's called rebate. And the rebate then it's issued back to the buyer as a credit. So for example, maybe they get $2,000 in a credit. Well, that could be used to cover their appraisal. It could be used to cover part of their, their home warranty. It could be used to cover title costs. I mean, there's a lot of ways to go about it.
Gotcha.
Very cool.
So interesting thing. So we're talking a little bit about loan options, down payment assistance programs, things to help folks get into homes. I remember, and Maisha, you might remember this. There was probably 5 years ago. It was not uncommon for us and a lot of smart agents out there who would represent buyers and help buyers get into homes with zero down at the end of the day. So for example, they're still putting their $1,000 or $1,500 at the time, $1,500 down in earnest money, but at closing, it was not uncommon for our clients to get that money back and walk into that home basically for nothing.
Yes.
Yeah.
Are you, as down payment assistance programs start to come back in this market, Jerry, do you anticipate seeing stuff like that with the products that are out there and with the volume of seller concessions that you're seeing right now on the lending side?
We're seeing, as you mentioned, the last few years, everything was so hot.
Right.
So if I came in needing a down payment assistance and there was 20 other offers in front of me, the odds were that seller was going to wad it up and throw it in the trash.
Right.
Right.
Yeah.
Unfortunately.
Yes. I think that the market has changed, and I think that we're starting to see the DPA programs, come back. I think sellers are willing to accept those offers because there weren't as many people looking to buy because rates moved up. But again, I think that to me, a DPA program would probably be the last option a buyer would look at. It's not that they wouldn't do it, it's just that we almost weed out all the other things before you go that direction. Because again, buyers would be surprised that they can come up with money. Most of them can.
But why would they want to versus go with the down payment? What's the benefit for them?
Because the down payment, remember, you have a buyer that's coming in and in essence, they're putting no money down.
Right.
That's risky for the lenders. Because if that buyer, for any reason, ran into a hardship, they don't have a vested interest in the house, so they're more likely to walk away from the house. So because there's more risk involved, the rates that are associated with the down payment assistance are going to be slightly higher than what you're getting if you're looking at the other options.
Great question. So that basically means for the consumer then, if you're looking to get into a home, but the resources, meaning available monies, liquid monies available to you, are kind of on the lower side, you still have an opportunity to get into a home using a down payment assistance program. However, you're going to get into a little bit of a higher interest rate.
You will get it. Yes, yes, you would get in a higher interest rate. And again, I think we had a client that's just recently where they didn't think that they probably could. They didn't think they had enough money, and we just started talking about it, and they found out, well, yeah, he had been at his employer for X amount of years, and he had $30,000 in his 401k plan, and it's just like, well, let's look to use that money. Not that you're pulling all the money out,
right?
But you're using some of it for your down payment. But again, they were under the notion that, oh, I don't have 20%, or I don't have this, so I can't buy a house.
And you only needed a small fraction of that.
And you only needed a small fraction. And again, I just think that's why people should just talk to someone like me, someone like you guys. Obviously, we would love for them to talk to us.
Yes,
right,
absolutely.
right, of course.
But I think and it does make a difference. Yes, it makes a difference because there's individuals that are in this industry, just like in any industry, where there's good and there's bad, right?
Right.
And hey, I want everybody's business, but at the same time, I may not be everybody's cup of tea, right?
Right.
They may just not want to work with me, and that's more than fine.
Not all
but if I
business
can
is
give
good
them
business.
information and I can help them in the process, and maybe they do go somewhere else, maybe the things don't work out how they thought with that individual, and maybe they come back, or maybe they felt after the transaction that, you know what, Jerry did an awesome job, and they may have a friend or a colleague or a family member, and they refer them over. So I don't know, I'm just like you guys, and that's why I love working with you guys, is it's just, you're just trying to do right by people.
Right.
Absolutely.
And that's it.
Yeah. Yeah.
Quick question, going back to the DPA. And when you say that they have a higher interest rate on going the DPA route, is there also like a mortgage insurance that's attached to it that's higher?
The mortgage insurance is no different. No,
okay.
because it's an FHA product, you're still going to have the same mortgage insurance.
Okay.
So, again, not to confuse the audience, but I mean, FHA did make some changes this year, so the mortgage insurance has reduced. So it reduced down to, I think, 0.55 is what it is if you're putting 5% or less down. If you're putting more than 5%, it moves down to 0.5%. But FHA will always hold mortgage insurance. The downside of FHA, if there were a downside to FHA, is the mortgage insurance is mandated for 10 years. So that means that the buyer, even though they may establish 20% equity within a few years in their house, their mortgage insurance isn't going to be able to be removed unless they came in and refinanced their house.
Okay, that's the only way it can get removed.
That's the only way you could get it removed.
Okay.
It didn't used to be that way. It used to be roughly 5 years with FHA, and then they changed it with a conventional loan. And going back to like we were talking with Home Ready, those could be removed at any point. So let's say that you had a first-time home buyer and they put down 3%. And let's say, and not trying to make a bad example, but let's just say for some reason grandparent passed away and they had left money to their grandchild, and they left them $50,000, and they decided they wanted to put that money into the house. Now all of a sudden their balance is going to be less, and then if they had a conventional loan, they could say, okay, well now I'm not at 97% anymore, I'm down to 77%. They could go in, they don't have to refinance the house, but they could reach out to the servicer and say, hey, I now have the needed equity. What are my options in terms of getting rid of my mortgage insurance? And that could free up another $100 or $200 for them.
Every month on your payment.
Every month on your payment.
Right.
Now, back to what we think is going to happen in 2024 and 2025, if rates go down, then that's an opportune time for someone not only to be able to reduce their rate, but possibly if their values have increased, they're able to get rid of their mortgage insurance at that time. Yeah, or even reduce the mortgage insurance that they have. So
get into a home now.
Yes. So even someone that goes DPA though, and some of those programs where you said basically they forgive like upon closing, could they then refi?
Yes.
How'd you know I was going to say that?
He's like, I know, yeah.
I know.
Yeah.
No, they can refi.
They can, yes.
How quickly can they refi?
Literally, they
no
could
time limit.
They could refi a month from now if they wanted to. Yes.
That's impressive.
That is very impressive.
It's a new product. It's not everybody has it out there, but it's a product that is extremely aggressive for buyers, and it just allows them to. they're not stranglehold by the fact that you're stuck in this loan for 3 years, and that's kind of how it used to be. So over the last few years, when interest rates went way down, borrowers that bought his DPA programs before that, many of them were stuck because they could refinance, but they were going to have to pay big penalties.
Right.
Yeah.
Agents, if you're looking for an amazing lender that has a wealth of a tool bag of resources,
Right.
Jerry Stoltz at Seville Mortgage.
I may talk too much though. People.
No,
yeah.
you don't.
No, you're good.
No.
You're a wealth of knowledge, so it's awesome. So thank you. We appreciate you.
Yes.
You bet.
Without going into the weeds, we really didn't talk about VA, but if you could give us like a quick misconception of VA from agents, because a lot of times we may have a buyer and we try to submit on a listing and they're like, oh well, it's VA, and we always get that feeling from some agents who aren't experienced or who don't have knowledge about VA, and they misinform their clients.
Yes, I think that used to be the feeling. They frankly are probably the easiest loans you can do. I mean, you have a veteran which number one, you would hope that they would want to look at the offer because they're a veteran, right?
Right.
But the fact that the loan is 100% guaranteed, the buyers, the majority of the time, they're going to look to put 0% down. The time frame as far as closing the loan is no different. I mean, you can close a loan in as fast as 14 days if you had all your ducks in a row.
Wow.
The appraisals are no different than a conventional type of appraisal, so there's nothing for them to worry about. I mean, to be very frank, I mean, if anything, FHA appraisals are the ones that are more intrusive than the others, because you could have, like here, you could have the eaves that the paint's that's missing or it's flaking, and then all of a sudden they come out and they require you to have certain things done. So FHA of all the products, I would think, would be the ones that agents would be more leery about than a VA product.
Now, real quick question for you. Can you tell me the programs that you were talking about? I know obviously they're offered here in Arizona, but are they offered in some of the other states that you work?
Yes. Everything that we offer is across the board. I mean, we're the products that we're offering, again, they're straightforward products from the VA product, for example. I mean, if you're a veteran, you can buy a home, frankly, anywhere. And things will change based on the areas that you're at in terms of what the county limits and things are like that. But yes, everything is out there.
And remind us once again, what states do you work in?
Ready?
Yeah.
Ready, folks? Get out your pens.
I have to think of the map. So we're in the state of Washington, state of Oregon, state of California. We're in Arizona. We're in Idaho. We're in Montana. We're in Colorado. We're in New Mexico. We're in Texas. We're in Florida, and we're in Georgia.
Wow.
Oh my gosh, 11.
Yes.
11 states.
And the funny thing is, and sorry, but the part of the reason we got in some of the states is because of the fact that we did do a lot of VA loans, and because the VA, I mean, they're the best people to work with because they're in units and they have others that they refer, and so we specifically started getting licensed in certain states because I would have a veteran that would call and say, hey, I'm going to be transferred, or I have somebody that's going to be here, can you do this state? And we're like, well, and then we would find out, we'd get with the state, we'd find out how much it costs to get bonded, what was the state requirements, how long did it take, and then if we knew that we could do it, then we would get set up in the state.
Well, awesome.
Dang.
Buyers, sellers, agents, if you're looking for agents or an amazing lender nationwide, we can help you. Just let us know.
Yeah.
DM, comment, whatever you need to do, let us know. We will get you.
And I know we're in Arizona, and for those who are kind of like, why do I have a Texas Tech shirt on? My son actually goes to Texas Tech. Yes, he goes to Texas Tech. He runs track. So mom's repping my son. So yeah.
This is fine, right?
Yeah, it's like shoot him up. Yes, that's it. Well, you're from Lubbock,
I'm
right?
from Lubbock. No Red Raiders.
And it's great. And when I first met Maisha, and she said, yeah, my son, he's going to school at this little place. It's called Lubbock. And I'm like, are you kidding me? I grew up by Lubbock. And I said, I'm a huge Red Raider fan.
Yeah.
So, that's why we get along.
Yeah. Right? Yeah. So thanks, you guys, for joining us. And like they said, DM us, message us, call Jerry. Jerry, do you want to give your number out right now?
I do.
Okay.
Go for it.
But no, my phone number is 480-720-4038. that's really, it's not even my office line, it's my cell phone. And so
See?
you could literally get me at any time. You could send me a text message if you had any questions. As I said, we work around the clock, and obviously would love to see whatever we can do for you and see if it makes sense.
And if you missed the number, we'll put it in the description below so that you can have it and a link
or
to his
if you
business.
can't reach him or whatever the case may be, or if you're just looking to buy and you want to get approved, definitely reach out to us. We'll get with Jerry and make sure that you guys get your loan
Get taken care of.
ready to go. So again, thank you so much for joining us. We're happy that you joined us for 2 episodes with Jerry.
Yeah.
Yes, and catch the tea on the next BYG. We look forward to seeing you next. And if there's something you want to see, something you want to talk about, or you're an agent or even a consumer and you think you have a great idea that you want to be on our show, comment, DM, and let's talk about it, and let's get you on the show. We'll catch you on next time, guys. Bye.
Bye.
Bye, guys.